Quality refers to the underlying characteristics of the company that issues a stock. We would say a company is high quality if they have low leverage, they have high profitability, and they're honest when they're accounting. The alternative would be low quality companies, companies that are over levered and perhaps stressed, companies that are low profitability, and companies that appear to be playing games with their accounting statements. Quality investing is premised on the idea that buying companies that have high profitability and low leverage and aren't playing games with their financial statements will have higher returns than a general market portfolio. We've studied quality now for many years, and we're suspicious of claims that higher quality companies provide higher returns. We're suspicious for two reasons. One has to do with fundamental investment beliefs. We like to ask if a strategy or a theme is going to provide a persistent future excess return, who's on the other side of the trade? And it's hard for us to figure out who are those investors that want to shun and avoid high quality companies. Most of the quality characteristics seem to be characteristics that people would choose to invest in and not to avoid. The second is more empirical when we study the evidence. We see very little evidence among large companies that high quality stocks outperformed other stocks prior to the last decade. We see very strong evidence that high quality companies have provided very strong excess returns over the past decade. That makes a lot of sense. Going into the global financial crisis, of course it was higher quality companies that traded off much less than junk. And we observe that there's something of a flight to quality ever since the global financial crisis. So the evidence is clear that for the past decade, there's been very strong outperformance by high quality companies. But whether the evidence is clear that there is a future excess return to high quality companies, we think is much more questionable. While we're skeptical that unconditionally buying high quality stocks, irrespective of their price, is a sensible investment strategy, conditioning your value estimate on the quality of the company is a very sensible investment strategy. What I mean by conditioning your value estimate is some companies deserve higher prices while others are just simply overpriced. And some companies may be cheap and have every reason to be cheap. You might think of them as a value trap, while others are great opportunities, good companies priced cheaply. Measuring a company's quality helps us distinguish between great value opportunities and value traps. Companies who are over-levered and distressed are likely cheap for good reason. Companies that have poor profitability are cheap for good reason. Companies that are playing games with their accounting statements, again, cheap for good reason. But a company that isn't over-levered, that's profitable, and isn't playing games with the financial statements, if it's cheaply priced, that's a great opportunity.